Welcome to The Explainer. Today, we're digging into a stock that seems to be defying gravity, CrowdStrike. With cyber warfare heating up across the globe, the big question on everyone's mind is this. Is this company an unstoppable force, or is it just a dangerously overpriced bet? Well, we're about to dive in and find out. All right, so here's our plan. First, we're going to look at why everyone's talking about this stock, especially in a shaky market like this one. Then, we'll get into what gives it an unbeatable edge. After that, we got to talk about that price tag. Is it really worth it? We'll also tackle the one big thing that could trip it up. And finally, we'll wrap up with a playbook straight from the experts on how you might approach this.
Okay, so first, let's just paint the picture of what's happening out there. The market is, well, it's pretty nervous right now. You've got geopolitical tension, high interest rates, and honestly, most investors are just trying to play it safe. It's what you'd call a classic risk-off kind of mood. And that's what makes this so interesting, right? It's a real paradox. In a market where everyone's scared, why on earth are the experts singling out this one super expensive tech stock? You gotta wonder, what is it they're seeing that maybe the rest of us aren't?
And here it is right on the screen. While lots of people are playing it safe, you've got big names like Wolfe Research and Morgan Stanley coming out and saying, nope, we're all in. They're basically making a huge bet that as conflict goes digital, top-tier cybersecurity stops being a nice-to-have and becomes, well, absolutely essential.
So what's giving them all this confidence? Let's get into the good stuff. What actually gives CrowdStrike this fortress, this moat that keeps competitors at bay?
Okay, so the first part of its edge is just that its tech is better. Think about the old way of doing things. You'd have to install a bunch of heavy, clunky programs on every single computer, and it would just slow everything to a crawl. CrowdStrike came along and completely flipped the script. They use just one tiny, lightweight agent that lives in the cloud. The best part? You barely even know it's there.
But here's where it gets really smart. It's all about the data. Their AI platform crunches trillions of data points every single day. So imagine it stops some new, nasty virus on a laptop in Tokyo. Instantly, every other customer around the world is protected from that same threat. It's like a global immune system that gets smarter with every attack. You combine that incredible network effect with major partnerships. We're talking giants like IBM and Intel. And you've built a wall that's incredibly hard for anyone else to climb.
All right, let's talk money, because this is where things get heated. The growth story here is amazing, no doubt about it. But it's got a price tag that'll make your eyes water.
Before we get into the charts, real quick, we need to know one term, ARR. It stands for Annual Recurring Revenue. For a subscription company like CrowdStrike, this is everything. It's basically a measure of how much predictable cash they have coming in the door from contracts over the next year. It's a huge sign of a healthy business.
And wow, look at this growth. It's undeniable. I mean, a 21% jump in revenue is great, for sure, but look over at that Falcon Flex ARR, up 120%. That's the number to watch. It tells us customers aren't just buying one-off products anymore. They're going all in on the entire platform, which is a massive vote of confidence.
Okay, but here it is, the catch, the big one. That number, 138, that's its price-to-earnings ratio. To put that in perspective, a typical stock in the S&P 500 might be around 20 or 25. This is 138. You're paying $138 for every single dollar of profit the company makes right now. That is a massive, massive premium.
And it's not a fluke. Look at this table. It doesn't matter how you slice it. Price to sales, EV to sales, price to free cash flow. Across the board, it's in the stratosphere. What this means is the market is expecting perfection. There's absolutely no room for a misstep.
And that's the danger of a valuation like this, right? It makes the stock incredibly fragile. Even a whisper of bad news can send it tumbling. And the irony here is just perfect. The biggest shadow looming over CrowdStrike comes from the very thing that makes it great, AI.
So here's the bear case. This is the big worry. What if a new AI, something like Anthropic's Claude, gets so good that it can just find and fix security holes in software before it's even released? If that happens, do you really need to pay for a premium service like CrowdStrike to protect you?
But the experts say, hang on, that's not quite right. Think of it this way. An AI like Claude is amazing at checking the blueprints of a fortress for weaknesses. That's the static code. But CrowdStrike is the army of guards on the wall, defending against a live attack as it's happening. That's the runtime defense. So they're not really competitors, they're partners. One builds the wall, the other defends it.
Now that's not to say the threat is totally gone, because we're in a full-blown AI arms race now. The bad guys are going to be using AI to get smarter too.
And for CrowdStrike, that means they have to spend a ton of money on research and development just to stay one step ahead. And all that spending, well, it could put a real dent in the profits that investors are banking on.
Okay, so we've seen the good, the bad, and the expensive. So what do you do with all this information? Well, the report lays out a pretty detailed game plan for anyone thinking about investing.
First up, let's look at where the analysts think this thing is headed. Short term, they see it getting back to around $450 as those AI fears calm down. If that amazing platform growth keeps up, then $500 is the next stop. And way down the road, if they can really deliver on profits, we could be looking at $600 or even higher.
Now, this is where traders really pay attention. These prices on the screen aren't just random numbers. They're key levels where the stock has bounced before. Think of them like lines in the sand. That $388 level, that's seen as a really solid floor where buyers tend to step in. And on the flip side, if it can break and hold above $405, that would be a huge green light for the bulls. So, using those key levels, the report lays out a very methodical way to get into the stock. The idea is you don't just jump in all at once. You start with maybe a third of your position around that strong support level. Then you have two choices. If it dips lower, you add more at an even better price. Or if it starts to take off and breaks through that resistance level, you add your final third then, confirming the new upward move.
And this is just as important as knowing when to buy. You have to know when to sell. The plan here is to be disciplined. As the stock hits certain price points, say a resistance area near $426, or that first analyst target of $450, you sell off a chunk, about a quarter each time. Then you let the other half ride just in case it really takes off towards those bigger long-term goals.
And this is really where it comes down to you and what kind of investor you are. If you're a swing trader, just in it for a quick move, then seeing the stock close below 380 is your cue to get out and protect your capital. Simple as that. But if you're in it for the long haul and you believe in the company's story, a big market panic that drags the stock down to 350, well, that might look less like a reason to sell and more like the buying opportunity of a lifetime.
So, when you boil it all down, this is the tug of war you're looking at. In one corner, you have a company that is just absolutely dominant with incredible technology. And in the other corner, you have a price tag that is just staggering.
Which leaves us with one final question to chew on. In a world where cyber attacks are only going to get smarter and more dangerous thanks to AI, what's the real risk here? Is it owning a stock this expensive, or is it not owning it at all?